Good morning, everyone. Welcome to the Macro Snapshot. It's the end of the week. It's Friday, August the 15th, Ferragosto for our Italian friends. So Ferragosto of 2025. Okay, so let's have a quick look and see. Obviously, what was a bit of a shock to the market yesterday and just caused a recalibration of expectations around the Fed. And talking of the Fed, we do have Jackson Hole coming up in, I think, about a week, about the 22nd. Anyway, towards the latter part of August, we have Jerome Powell's last speech at Jackson Hole, and that's going to be extraordinarily interesting just to see whether he gives some kind of green light for sort of a cutting cycle to begin, or whether he actually pulls back and sort of says, no, the economy actually is still relatively sort of heated. Inflation is still sticky. There's no reason to cut. And also during the speech, really sort of, goes very strongly and supports sort of Fed independence and sort of maybe goes out in a blaze of glory, supporting the institutional independence of the Fed. So it's going to be very, very interesting. From memory, I think it was the 22nd. Anyway, no doubt next week we'll be talking about that. But that's something which the market is probably actually is the main focus of the market for the next, sort of 5 to 10 days. In the meantime, though, we did get some very, very hot PPI yesterday. I looked at a lot of the details after it came out yesterday, and it is a little simplistic to say, oh, this is, purely sort of bad news and very hot because, for example, in the services, a lot of that's actually financial services. And, the cost of having sort of financial advice went up a lot for some various reasons. So the point I'm trying to make is that on the surface, this looks horrible, but actually it's merely bad is what I would say. But let's just look at what we did get. We did get pretty incredible. The final demand month over month expected at 0.2 over last month's 0 came in at 0.9. So that's a very, very unexpected and very hot kind of number. And if we look at the other numbers as well, excluding food and energy, the monthly number also at 0.9 after being 0. Et cetera, et cetera. So you look at all these numbers, pretty nasty. And then if you look at the initial jobless claims, absolutely no problems there. They're still very, very solid. And then if you look at the continuing claims, actually was a little bit down and a tiny bit of downwards revisions from last time. So again, just looking at this sort of these job numbers here, the employment numbers, what a lot of the analysis is showing us is that companies are just not firing that much. On the other hand, they're not really hiring. So we sort of had this very flat job market at the moment, which is neither expanding nor contracting particularly. But I continue to read headlines, commentators saying, oh, the job market's, definitely weakening. And you could argue that there are pockets of weakness, but, overall, some of the timely measures here, which is the weekly numbers, initial jobless claims and continuing claims are relatively solid. And if we continue to have sort of sticky inflation such as this PPI, you have to say, why would the Fed not only be cutting 2 or 3 times this year, but why cut at all? So it's a very interesting dynamic going on. Now, what we did get with the market was quite a lot of repricing on the back of that PPI. Let's have a quick look here and see where we're at. So you can see here that the expectations, let's say for the September meeting, they won't change that much. They're at about 25, I think 25 basis points. So we're now down to about 23 basis points. But the one I like to look at as a sort of a, kind of a benchmark is the December pricing. And you can see that's still at 2.2 cuts, although it's come down to 57 basis points. And you can see here on the tick chart for the December pricing, before that PPI data yesterday, we were trading at about 60, 62, 63 basis points of cuts, so well over 2 cuts. And you can see here that as soon as that data came out, the short-term interest rate market, so the STIR market, definitely repriced in a hawkish way to the tune of about 5 basis points or so. And that's pretty normal. But the point I'm trying to make here is that we're still pricing in cuts. It's not as though the market has said, oh, PPI is higher than expected. The CPI is still well above target. The real economy is still doing pretty well. The employment situation is still strong. Oh, maybe the Fed doesn't need to cut for sort of 3 or 6 months. The market is still believing that the Fed will cut 2 to 3 times over the next, sort of 3 to 4 or 5 months or so. Quite interesting. So I'm just curious to know that if we get the next job numbers and the next CPI, if both of those are relatively sort of on the strong side, at what point does the market start to price out or definitely sort of reprice these kind of numbers here. And we maybe go to one cut in the next 2 to 3 months or so. Interesting days we live in. And of course, Jerome Powell will also give us a lot of information about that at his Jackson Hole speech. Okay, so in terms of the data today, we do get a little extra data today, which could be quite interesting. It's a choppy number. It's a kind of a noisy number. But we do get the retail sales. So let me just clean this up here. No, actually, I'll keep it on there. So you keep the retail sales here. So they're coming in this morning at 8:30. They are expected to remain flat on the month-over-month number. But the most important number is the number excluding autos, which is expected to actually drop a little bit. So you can see the number, X autos and gas and gasoline. Those numbers are actually both expected to drop back a little bit. And then the other important number is the control group. That's sort of like the supercore number in a sense. That's also expected to drop back a little bit. So that's what the market, the consensus is for a slightly softer retail sales. Look out for revisions because often these numbers are revised because, as I said, it's a complex number. It's a noisy number. What is also kind of interesting potentially could be the import price, let's say excluding petroleum. And the import price, some people are starting to look at that as a gauge of pressure from tariff prices. So if we believe that the tariffs are being applied to imports, the logic here is that if the import prices are going up, that could be a sign that sort of exporters from places like China or whoever are actually sort of increasing their prices to compensate for tariffs. So let's have a look at the import prices there. We also get industrial production, which is always interesting to look at. Again, just trying to get a sense of whether the US economy, perhaps is showing some signs of slowing, or whether, according to Trump and the Trump White House, this is a glorious new age of American manufacturing. We'll see. We'll get some manufacturing and some industrial production numbers this morning and business utilization. Also, a little bit later, a number I don't love at the moment, but we still need to look at it, is the University of Michigan. The reason I don't love this number is because it seems to have become incredibly, well, two things. First of all, people are not responding as a different response mechanism now. Before, it was a viva voce thing that people would actually respond on the phone. And the idea was that they felt a little bit of pressure not to be exaggerated. Whereas now, of course, it's gone online and people are giving more and more exaggerated responses because they don't have that sort of checkpoint of another human sort of researcher on the other end of the phone saying, you sure you think inflation is going to be 10% at the end of the year? But now we're getting like online stuff. People feel very comfortable behind their keyboard saying, oh, I think inflation is going to be 10%. So that's one reason. Secondly, it's become very, very politicized, that the Democrats and Republicans are giving completely different viewpoints of the economy. Nonetheless, I guess we'll keep an eye on it, especially for the inflation expectations. Expected for 1 year, 4.4, which is pretty high, which, is that realistic? That seems a tad unrealistic to me, but hey, there's the number. But also, maybe more importantly, sentiment and expectations. Anyway, take that as you will. That's what's going on this morning. So that's all quite interesting. Now, in terms of some other stuff going on, we do have the Trump summit today in Alaska. That is happening at 11 o'clock Alaska time, which Eastern time is, I believe it's 3:30. I'll have to double check that, 3 or 3:30 Eastern time. So that's almost at the market close. And because that's when the summit or the meetings are beginning, they're not, Trump's not scheduled to leave Alaska until about 5:30 p.m. local time. So Alaska time, which is well into the evening here in North America. Therefore, I don't know if there's going to be market moving today. Any headlines, will no doubt be reflected on Sunday night when the futures open, and then on Monday. What's probably the main sort of interest there is going to be the oil market, just in terms of, because Trump himself has sort of downplayed pretty much the possibilities of having some kind of sort of breakthrough. We'll see. But the thing to keep in mind in terms of the oil market here, and I've just got here the futures curve. Now, you see the futures curve here is still pretty strong in the sense that this is still very much the front contracts is a strong backwardation curve here. So very much this doesn't look like a market which is going to be collapsing, at least the physical market, anytime soon. So that's relatively sort of positive. And if you look here at the spread between CL1 and CL2, so that's pretty tight. That's just the front contract, the prompt contract versus the second contract. And you can see here on a shorter time frame on a 30-minute chart that although the prices, the outright prices on the top panel have been coming down. They're holding up. They're okay. You know, they're in the 60s here. And you can see that the actual spread, which did have a period of softness. Now, as those outright prices are going up, you can see the spread is actually has pushed up a little bit over the last 36 hours. And we're now at almost $1 at about 90 cents spread, which is, you know, relatively okay. So, you know, as I say, the curve and the spreads, the time spreads are showing us a market which is, I'm not going to say strong, but it's certainly not weak. It's kind of stable. And therefore, getting back to the Trump-Putin summit, the question here, and let's just bring up zero hedge. Let's just bring up the chart here of the CL1 contract, so the front contract, generic contract here. You can see that oil has pushed down below all of its moving averages. You can see here that it's broken support, but it is kind of stabilizing a little bit here. And there is a little, you could argue there's a little bit of a sort of support line here. And there was a, you know, a nice bounce a couple of days ago. So if the headlines are sort of generally positive and you know, they agree to keep on meeting, and there's proposals for ceasefires, and it seems as though dialogue is ongoing and a generally positive sentiment. You have to say that that would indicate potentially less probability of sanctions on Russian oil exports, which you could argue is maybe a little bit of a negative for oil, just because, you know, presumably those Russian oil supplies would continue to flow freely. On the other hand, if everything breaks down and there's I don't know, a fist fight between Trump and Putin and nothing much happens, you know, you could argue that the temptation of Trump, the White House, to unilaterally impose sanctions on Russian oil exports could rise, and therefore that could put a little bit of a risk premium into the oil market. So at the moment, pretty flat, kind of like a basing sort of stabilization sort of pattern looks to be developing here. Let's wait and see. And as I say, that's probably going to be a story more for the Sunday night open of the oil futures rather than now. Or it could just be a non-event because, you know, both Trump and Putin's side have downplayed the possibility of, you know, sort of news-grabbing news sort of headlines which are really going to sort of move the ball. Because obviously Europe needs to be involved, and especially Zelensky, before we get a true situation. Nonetheless, from a sentiment point of view, I mean that this horrible war has been going on for you know, 3 years or so. So if there is a sign that we're definitely getting closer to a ceasefire, that's going to be a good thing for the world. But secondly, for the markets, that would probably be a little bit of a risk on sentiment. Excuse me, just having a bit of tea. And that's probably going to be most reflected, maybe not even so much in the currencies in the US dollar, but let's say something like the euro. So something to be looking out for there is going to be the cross pairs. Anything with a positive sentiment coming out of that, that would probably be sort of more of a risk on here. So we could see something like euro JPY having a bit of a push upwards, and especially watch something like euro Swiss franc here, because we see that the euro has really been pounding the Swiss franc over the last couple of weeks here, and, you know, potentially that even could have another, you know, sort of a push a little bit higher if there's some positivity coming out of the Trump-Putin talk. So keep an eye on the euro, especially on, let's say, Sunday night open. That could be something pretty interesting to be looking at. Okay. Just talking about Europe, there's been some pretty interesting price action going on in the European bonds. And I just want to draw your attention just to what's been happening. Especially, I want to look at the long end of the German yield curve here. And you can see here that the German yields on the 30-year on the Buchsel are really pushing higher, and they're actually getting into sort of new, you know, recent highs, as you can see here, now over 3.3% here. And that's just been grinding up for the last, you know, two to 3 months or so, on the back of the fact that the Germans just continue, they want to be spending more on infrastructure, on defense. Their pension program is very sort of underfunded. And essentially just a lot of this pressure is coming out at the long end of the curve. Also on the 10-year, you can see the 10-year curve, the 10-year yield seems to be wanting to sort of break out quite a lot higher here. It looks like pretty dangerous. I mean, it could have a bit of resistance, but that could break it out. And if that's the case, it could be on its way up to 2.9 or 2.95 here. So that German curve is also steepening quite a lot. So you see here the 2s, 10s, you see that looks as though it wants to go higher, and the 2s, 30s. So quite a lot of steepening here in the German yield curve. And there's long end bonds under a lot of pressure, and that's a global thing. But if we also look compared to some of the other European bonds, let's say the Italian bond, pretty extraordinary performance here. Compared what's happening in Germany to, let's say, the Italian 10-year yield, which, as you can see, is pretty flat here. down at about 3.5. And if you actually look at the spread, which I haven't sort of shown you guys for a while, look at this spread here on the Italian over German 10-year, which historically has indicated a lot more confidence in the German bonds. But this spread now, it's broken to new, and I'll put that on a weekly chart just for a bit more of a perspective here. You can see just how much of a move downwards this has been, favoring the Italian bonds. And you can see here that going back to, let's say, 2022, we're up at 240 basis points. And again, on this weekly chart here, you see that where we're at just historically, we've broken a very important level here, so much so that I will get rid of this horizontal support line. So now we're starting to break these levels here, and we're getting into historically quite interesting territory here. So you see we're only at 77 basis points here, and there is for sure a little bit of congestion down here, and that could be it. But that's quite an extraordinary move, and that just shows that in Europe things are changing. That Meloni has convinced the financial markets that the Italian government, sort of the political situation is relatively stable, and also the fiscal situation. The Italians are doing their best, although they still have a huge debt to GDP ratio. It's like 140% or so. But at least at this point, the financial markets are quite happy getting that extra pickup over the German bonds. So that's a real sort of a slap in the face for confidence in historically for German sort of fiscal prudence. And as we see here, there's just relentlessly, look at all these moving averages here, just relentlessly pushing down. And you can see here also the Italian bond over the French bond, similar kind of situation here. So you really see that's almost a parity now. We're at where are we at? Like basically 9 basis points, and at a certain point that was up at 1 or 1.5% or so. So interesting here that the French is doing relatively well against the German, but it's really the Italian which is outperforming the German at this point, and also the French one. Interesting. If we look across at the 2-year. Obviously, yesterday we had this is the price here. So we had the 2-year coming off the front end of the curve. It did not like those PPI numbers, those hot PPI numbers, as we saw with the SOFR and the Fed funds futures repricing. So the yields being pushed up on the front end of the curve yesterday. We also see though that the long end of the curve in the US, the ZB. The 30-year futures also coming down quite a lot and continuing to fall. And that's also causing a little bit of a steepening of the curve. So both in, let's say, Germany, but also in the US, there is this sort of sense that the front end is relatively anchored, although in the US it's moving up and down with expectations around the Fed and data. But really the question here is steepening, and really the way to play this is a steepener trade, and this idea that the central banks at the front end are sort of holding those rates, but at the back end, it's taking all of the pressure of ill-disciplined fiscal sort of policies, a lot of deficit spending, and an economy which is still doing reasonably well, and sticky inflation. So if you put that all together with a relatively strong economy, sticky inflation, and governments which refuse to cut costs, we're basically having these huge deficits, even with a strong economy. And the fear is that, let's say, for example, were the economy to weaken in the US, then you have less tax receipts, you have more outgoing expenditures on social welfare programs, and then you have extra need for issuance and more deficits. So the point is that even in the good times, this curve is steepening. And if we have a bad economy or a weakening economy in the US, that could also start steepening the curve a little bit more. So just interesting there to see that. And let's just quickly throw up the US. Where are we? The US, sorry, where's my yield curves here? Let's say the 2s to 30s. You can see here it's at the top of the range, starting to push higher. And so if we continue to get strong US economic data and sticky inflation, that is going to push higher. And the other thing as well, just in terms of monetary policy, remember that even if the Fed is cutting, that might cut the front end of rates, but that indicates less attention to fighting inflation, which is not good for the long end. And so we could have the paradoxical situation here that even if Powell at Jackson Hole is relatively dovish and signals that a cutting cycle is about to recommence, that may paradoxically lower the front end yields, but may not lower the back end yields. We could have a pretty vicious steepening, because the back end of the yield curve will not appreciate the fact that the Fed is not on its game and fighting inflation. And keep in mind that when we had the jumbo cut in at the Fed back in September of last year, look where the yields have gone, and the curve has steepened. So the point is that just because the Fed is cutting, it doesn't mean that the long-term yields need to go down. The long-term yields will only go down if the economy weakens and if CPI, if inflation is seen to be under control and it being attacked. So that's something definitely dynamic to keep an eye on. Final thing just to have a look at, even with that data yesterday on the PPI and the yields going up. It's interesting the dollar had a pop. It had a pretty nice little pop yesterday, but as you can see here, already giving back some of that. I don't know if that's anything to do with Putin and Trump meeting, a bit of risk being taken off the table. I doubt it somehow, because as I say, really it's more the European currencies which are reacting more to the situation in Ukraine. But if you look at that here, just look at the dollar. This is signaling to me a little bit of weakness here. And you can see that already giving back some of those gains. And these moving averages, the 20s and the 50s, which are sort of going sideways, are starting to move down a little bit. And this little reaction here may just be seen as a kind of a 1 month kind of deal. Also, what's interesting to look out for is the Japanese yen, which is starting to show signs of a little bit of strength. You see here the dollar versus the yen, despite the PPI pop yesterday, again, that was only lasted for 24 hours and now is pushing down. So you see the US dollar weakening against the yen, and we're about to go below the 50 and the 100-day moving average here, and we have this sort of uptrend line. So if it breaks down there, we're starting to break down also below fib levels, and that could be headed on the way down. And just finally, just want to leave you. We did have some data overnight from Japan. We had the GDP number, and the GDP number came in. I'll just put it up here. The GDP number came in quite strong, sort of um, stronger than sort of expected. You see here the GDP here. So the survey was sort of plus 0.4. Now look at prior minus 0.2. And that was there's a lot of confusion about the tariffs and whatnot. But now that it seems as though the tariff situation is, in a certain sense, is understood, this GDP, interesting number here, the seasonally adjusted quarter over quarter, up 1%, which is quite good. You look at some of the other numbers here, seasonally adjusted. Also, that's the annualized quarter over quarter. Just the Q over Q number itself, up 0.3. But basically, some quite positive numbers coming out of Japan. And that's also reflected, if you look at some of the stock markets, let's have a quick look just to finish off here. What we are seeing is that global equity is almost outperforming the US. So we've got the VIX here very, very low and flat. But you look here at the ES, it is grinding higher for sure. Absolutely. There's no, I'm not going to say that it's weak because this is new highs and grinding higher. We see the NASDAQ. Actually, just while we're on this, it's interesting that yesterday the equal weights sort of gave back a little bit, and also the Russell gave back, a little bit yesterday. But I just want to draw your attention to the fact that Europe's going pretty well. But look at something like Japan. Where's my Nikkei? Look at the Nikkei here, really ripping higher. And then also you could have a look at the Topix. I'm just going to put on the futures here, the Topix futures. So if we have a look here, you can see that the Topix futures in a clear, like a very powerful rebound after the Liberation Day tariff stuff. Ever since then, they've been on a tear, just ripping higher and higher. And look on the futures here for the Topix, just ripping, a clear uptrend. But also global equity, like you look at in Australia, new highs. You look at Canada, the stock market doing very well. So global equity doing very, very well, and in some cases actually outperforming the US. And that's just something to keep an eye on. Okay, guys, I'll leave it there. Have a great weekend. Let's keep this going next week. In the meantime, we have some interesting data at 8:30 this morning, and then of course we'll see what happens, much later in the day, even over the weekend, as we get the summary of what happened between our friend Trump and our other dear friend, Mr. Putin. Okay, have a great day, and thank you very much.